And there we go. We're live. All right. Happy Friday. Been a while. Mostly doing reels these days. Not doing a ton of the long form videos. Really just a matter of time. It's just a matter of time. The market's heating up. It is what it is. It is what it is. So a lot to go over today. I'm going to kind of do the kitchen sink today. This is when I have time. I normally do the video later, but it is what it is. So we're going to take a look at a few things. We'll talk about mortgage rates, the newest data on housing. Some stuff that's going to blow your mind. We'll talk about what's happening with rents. What is going on with you? How are the elections not done yet? Ridiculous. We're going to look at the dollar index. That's a big one today. So we're going to go through all those things. I'll tell you what I think is going to happen next. We're going to pull up, do some technical analysis. So let's take a look here. First and foremost. Oh, did I not get rid of that all the way? There we go. Let's take a look at mortgage bonds here. This is, so far, I like what I see. I mean, we have this sort of double bottom here, right? That's always good. There's also sort of a reverse head and shoulders going on here, and that's a very powerful pattern for mortgage bonds. We talk about it all the time. And there's a nice channel, upward channel that's being formed here, which looks really good. The most important thing that happened on this whole chart was after last Thursday when we had this 200 basis point rally. Since then, there's been very little rejection. We have consolidation here. This is the market accepting this new price. This means that buyers are still there. I believe it's Wall Street is closing their short positions on bonds, which is very, very good for the future of mortgage rates. And that's really what it looks like, because you see lots of buying activity coming in every day until today. Today is the one day where we've got a wick on the top at resistance. It's the only candle I don't like, but it's a Friday. There's a lot of wild things going on out there. So it's not too surprising. I don't love the formation that has been made here, by this consolidation. But nonetheless, if it continues to suit and moves here next time, then that could be the one that blows through. So I am expecting mortgage rates to drop in the near future. That's my expectation. It's just the way that it looks. It looks very, very good. Lots of green candles in a row here, which just means buyers are coming in. We're closing higher than we open. So the opening price, the beginning of the market, we're closing at a higher price than that. That's what the green candles mean. And we've got how many of these in a row? How many days in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I mean, it's hard to be bearish, right? Very difficult to be bearish. And I do expect mortgage rates to drop. If we look at kind of where we are right now, this is from Mortgage News Daily. My rates are lower than this, 6.375 right here, closer to 5.875 or 6% on these. Other ones are okay. But, so you got FHA, VA, still right in the high fives, right at 6%. Conventional mid sixes, maybe 6.375. I'm talking like minimum down type stuff. You're putting down a lot of money. We've locked one in the fives with no points for conventional loan this week. I mean, it just depends on how much you're putting down. For most people, though, we're just kind of talking about minimum down payments and stuff. Let's do the stories first. So it's always difficult to sort of interpret this data, but I'm going to do my best to give you sort of what I think is important to note about this. Home sales fell for the 9th straight month in October as higher mortgage rates scared off potential buyers. That's one way to put it, but it also scared off potential sellers. See, the thing is, like, real estate's tried and true. It's been tested. It's been through hell. And people, one of the things that we underrated, and I underrated this in the market, is people who went through the crash. There's people who were traumatized by it. They're worried about it happening again. But then there's a lot of people who saw it and went, you know what? I get it now. Real estate will recover. Real estate will recover. That's what the crash taught us, because the real estate crash of 2008 was horrifically awful. Horrifically awful. What was going on, the fraud within the industry, within the secondary market, was rampant, horrific. And we recovered quite nicely from it. In fact, we'll look at this here in a second. I got something really interesting to show you on this chart. But so sellers are not just willing to go to panic sell. And they don't have to with forbearance and all of these different options that they have with their banks. So what you're seeing sellers going, no, I won't sell it for that. Just won't. So stuff is sitting on the market, and then sometimes they're just pulling it off the market. That's why the volume is down. The number of transactions is down. And that's what they're talking about here. So you have to, first of all, ask yourself, what are they actually talking about? Home sales fell. What does that mean? That mean prices fell? Does that mean, what does it talk? What fell? The number of homes sold fell. So the quantity of homes that sold fell. Scared off buyers, also scared off sellers, guys. Slowest pace since December 2011. Does anybody remember what December 2011 was? I'll give you one guess. The ultimate time to pull the trigger. December 2011, really all of 2011. But I mean, that was right at the end of 2011, beginning of 2012 is what has always been thought of as the bottom in the real estate market when the sentiment really changed. The median price probably bottomed prior to that, but definitely in 2011 and 2012 was when the sentiment bottom was. The sentiment bottom. So this is the slowest pace since the sentiment bottom after the great crash. Pay attention to that. Buyers need a six-figure income to afford a typical home, report finds. This is true. Prices of homes, and this is one of the reasons why I believe that San Diego is still extremely undervalued. You look, just go, I implore you to do this for your own sake, for your own knowledge. Go and look at real estate in other areas. Maybe it's an area you fantasize about. Maybe it's an area you think is cool. Smoky Mountains. Okay, Tennessee. Where's everybody going? Nashville. All right, let me look there. Let me look here. You will find some like old beat up homes there for 200,000 or something, which you don't have that option here. But when you look at like the nicer homes, the newer homes, the good neighborhoods, you're still talking about 5, 6, 700,000. This first hit me like 5 years ago when I was in Minnesota, in the Tri-City area for my daughter's volleyball tournament. And I walked around and I just had my app out and I was just looking at homes that were for sale. And I was just walking in neighborhoods. It was a pretty nice neighborhood near a meditation center that I had gone to. I went for a meditation walk and I was looking at real estate. And the homes were 6, 7, 800,000. This is 5 years ago. And I was like, good Lord. Do these people know they could buy a house in San Diego for this? Because 5 years ago in San Diego, you could buy a nice house. You get a pool house and everything for 800,000, 700,000. It's much more expensive to own real estate in other areas than people realize. Do your own research on that. Check that out. But here's the interesting stat. So in October, U.S. buyers needed to earn $107,000 to afford the median monthly mortgage payment, typical home. Okay. What's interesting about that is it's 45.6% higher than the yearly income needed to cover the mortgage 12 months ago. Multiple reasons for that, right? And it's not necessarily higher prices 12 months ago, although there were slightly higher prices, but it's higher interest rates. So if we believe that interest rates are a temporary phenomenon, maybe this is useless information, but it is factual nonetheless. Rent growth slowed to the lowest level in 18 months. This thing really interested me. So rent.com sends me these reports, and they sent me this one yesterday, I believe. And so you can see here, rents definitely, this is national, going through their cycles, have been trending higher for sure. But you look at this yellow line right here. That's the year over year percent change. So the percent change, 8% year over year, is a low level, according to them. Rent growth slowed lowest in 18 months. Well, it's still 8%. It's true. It has slowed. I mean, it's factual. But I mean, obviously, we cannot expect 20%, rental growth year over year over year over year. We can't expect home price appreciation 20% year over year over year over year. There has to be breathers. Right now, there's a breather in the rental market, which is interesting because what that tells you is all the people who, so there's two possibilities here. I'll let you decide what you think one is. You know which one I think it is. Either people who were going to move said, you know what, we're going to figure out how to stay where we are because they couldn't buy or they don't like the sentiment in the market. We're going to figure out how to stay where we are until we can buy. Or they're saying, you know what, we're not going to go rent somewhere else. We'll take the rent hike here at our current place and we'll just deal with it because going somewhere else is going to be more expensive. So those are two possibilities. Can I tell you that both of those scenarios bode well for home values? Both of those scenarios put people in line to make a purchase at some point in the near future, because if you wanted to move, but you couldn't because the rental market was so hot and you weren't ready to buy yet, or you wanted to buy, but you couldn't, you didn't feel like it was the right time, right? Oh, we're going to wait a year. How many people told you that? If you're in the industry, how many people told you that this year? We're going to wait a year, or we're going to wait till next year. A lot of people pushing to the right. There's pent up demand like crazy. I wish there was a way to measure not mortgage applications, which we can measure, but actual pre-approvals. How many people are pre-approved to purchase a home, and we could keep track of that set. If we could keep track of that, we could really have a good idea how much of this is stacking up. But I believe there's a lot stacking up right now. I've had the busiest 2 weeks all year, these last 2 weeks. All right, let's see. We went through this, bullish there, that, elections. There are still 7 seats in the House that have not been called yet. Here we are almost 2 weeks through the elections. What in the is going on? Seriously. My entire life, this has all been done in one day. And in the last 2 years, with the help of machines, we're not able to get it done in 2 weeks. It's pathetic. It's a travesty. And everyone needs to be not okay with this. Taking this long for elections is not okay. All right, let's go through. We're going to go through one by one. I'm going to explain where these different instruments are and why it's important to understand what's going on. This is the dollar index, the DXY. Notice we got a nice bounce right off of the support as expected, but we had a breakdown of this upward channel that's been going on for a long time. It's a really, really, really nice channel. We expected that, right? We expected it to break down at some point. It's just been too long. It's been running. But notice each one of these red arrows is where the Fed has raised rates, which should strengthen the dollar. It makes sense. When the Fed raises rates, boom, you get a pop. Okay. Fed raises rates, boom, you get a pop. That makes sense. What is interesting is the last time the Fed raised rates, we got 1 day of green, and then it has absolutely fallen off the cliff, which tells us the market does not believe the Fed is going to continue at this pace. The market at least believes the Fed is going to slow their pace, slow their roll, even though Jay Powell said nothing of the sort in his interview after the last rate increase. I mean, it sounded like there was still gangbusters for them. This is where it's at. Now, we're no longer in this upward channel, the downward. Well, you know what? Let's do this real quick. Maybe this will be interesting. Could be. Here it is. Oh yeah, watch this, guys. Okay, hold on. We may have cracked the code here on the DXY. This is so important because as goes the DXY, the opposite goes everything else. So if this is going down, then everything else is going to be going up, basically. Look at that. That's it. So we're getting interaction with the middle of this channel too. This is the channel. We just cracked the code for the DXY. So this is where the dollar index is. This also explains the bounce down here. Everything makes sense now. So we can probably expect a little bit of a bounce off of this. If I were playing this, yeah, I would say we could probably expect the DXY to bounce maybe to 109-ish. And that might be it. And then get a nice follow through, moving lower. So what does that mean? This is part of the reason why you're seeing the stock market rally, even though the conditions aren't ideal. You're seeing companies like Gap say, hey, we had a good quarter, but we're tempering expectations. How many companies have tempered expectations recently? Amazon, we're laying off people. Target, our quarter sucked. What's happening is a lot of expectations are being lowered, okay, significantly. And we're heading into really, retail's prime season. When I worked at Sears for many years, and they made 60 or 70% of their revenue in the final 2 months of the year. I mean, there's an expectation that this Christmas spending season is going to be weak. And my prediction is that is going to turn out to be false. Remember, we still have record household wealth. People still have tremendous amounts of equity. I don't really see a pinch on Christmas like a lot of people are predicting, particularly these CEOs who are giving these quarterly reports recently. I think they're setting up for a very, very big move in the stock market higher. I could be completely wrong. There's a lot of people who think that the pain has just begun. I couldn't disagree more. The pain was this big, huge move higher in this guy. That's the pain. So that looks to be over to me. And this is the reason why this dollar index is so important to pay attention to. Okay, spend enough time on that one. S&P, you can see here, still in a bearish horn scenario, but have flipped, this important resistance area here at the 50% retracement from the most recent cycle high to cycle low. That rejected off that the first time, knifed through it the second time, has turned into support now. looks like it's going to make a run on getting out of this bearish horn. That's what this looks like to me. We have some consolidation here at the 618. Looks like we're moving higher. Now, I could be wrong about that, of course. Markets can always go either direction. But after looking at the DXY, it looks like that's what the setup is. So, I too have seen a lot of FUD type stuff out there, a lot of negative stuff, a lot of, oh man, this is just the beginning. Michael Burry said on Twitter, you would not believe how short I am. This guy has only been right once, but he's always short. So good luck to him. Let's see. That one, I'm not going to do the NASDAQ. I'm going to do this one. Bitcoin looks terrible. I mean, Bitcoin just looks terrible. The FTX thing, listen, so two things I'm going to talk about. I'm going to follow up on VA loan assumptions and FTX, Gemini US dollar. Some of my friends have gotten caught up in that Gemini US dollar issue. There's problems with all sorts of crypto exchanges. There's basically inbreeding going on in the crypto world, and everyone was connected in one way or another to FTX and Alameda and these companies that were essentially fraudulent. Now, a couple things. I really am sorry for people who followed me into the Gemini US dollar and then did not catch my exit message. I should have probably posted in more places or more times. I know not everybody watches every video, but I exited, that position last week. I completely got my money out of there. And now there's people with money that are tied up in the Gemini US dollar. And while I don't think they'll necessarily have a problem getting it out ultimately, it's scary when you have six figures behind the wall and you can't get to it. So it's a real bummer. But I will say one thing, it's surprising to me that Bitcoin has held up so well. Considering this is a major catastrophe in crypto. And so for the fact that Bitcoin is still at 16,000 something, I can't believe it, to be honest, that it's still that high. And so I would say that says something to the strength, or it could just mean that, look, there's more downside coming. I'm not quite sure. I think the crypto winter is not over, most likely, although capitulation events like this do tend to mark bottoms in markets. So if you look at like market bottoms, usually there's a capitulation event similar to this, a black swan, whatever you want to call it, a situation where you didn't see something coming, it comes, it knocks the market down, weak hands let go, strong hands grab hold, and then it moves higher. I mean, there's been so many different opportunities for that to happen. Bitcoin, this consolidation here, this consolidation. I mean, there's been so many times where it could have done that, hasn't. I don't have faith that it's going to happen anytime soon, but I am still dollar cost averaging into it, lowering my cost basis every week because it keeps going down. But it is what it is. It's a decades long investment for me. Ethereum, basically in the same boat. So all these things that are circulating, we're seeing what's happening. The real estate market has become quite busy. Now, some people believe that it's possible that, that could also be happening because people are looking at what's happening in crypto. People are starting to distrust the stock market due to the volatility. And they're going, you know what, real estate, that's something we can count on. That's something we can understand. That's something we can see, hold, and touch, that we can make sense of, that we know isn't going to just go to zero overnight, and so that could be part of the reason why you're seeing some people who've pushed this idea to the right getting into the game. All those things are possible. Here's what I can tell you from how I feel about it, what I'm seeing. I'm seeing a lot of people getting good deals, negotiating well, captured some great rates here recently. I see, interest rates really look like they're poised to continue to drop. Anything could happen, but it looks like interest rates continue to drop. How about this one? Okay, here's my last aha for you. Q2 this year, okay, through Q2, the average price of a home, according to the St. Louis Federal Reserve, was $527,500. Okay, and that was the highest on record ever at the time. Now we have the numbers in for Q3, and look at this, almost $543,000. That's a 3% increase quarter over quarter. How could that be? How could it be? Well, it is just median, right? Sorry, it's average median sales price, which means maybe there's higher price homes are selling more. You tell me, how does this make sense when all we've heard is market's going down, prices are depressing? That's all we're seeing in the marketplace. It's not happening like that necessarily everywhere. And overall, I do expect this number to go down in Q4. But how interesting is that between Q2 and Q3? Well, rates were not great. Rates had gone up a lot. We saw an increase of 3% in real estate values over the whole course of the nation. Very interesting, right? Is this a hidden divergence? Is this, a white flag scenario going, hey, look at this, pay attention to this, this is what's going on. This is what people love about real estate. This is the real estate average value chart going back to the 70s. It goes up and it's parabolic. It is parabolic. People say, well, that parabola cannot last. And that's true. Usually it breaks. Here's when we had the break in 07. We topped out in Q1, and then we actually hit our absolute bottom in Q1 09. But you saw how we kind of went sideways here. There was still a lot of foreclosures and weird stuff going on. This was the real bottom right here, Q4 2011. Remember the earlier article we talked about? Since December 2011, that is the slowest pace since December 2011. What was December 2011? Let's take a look. Q4 2011, that was the double bottom. That was the ultimate entry area where the market just took off from there. That's what that was. So when we're talking about, we're seeing this data here, always go and look. When they say, oh, this is the slowest or this is the fastest since this date, go back and look and see what's going on that day. Slowest pace since December 2011. Sales of previously owned homes dropped almost 6% from September to October. So month over month numbers. Slowest pace since December 2011. And we know December 2011 was like the absolute perfect entry into real estate post crash. So we can see as well on this chart. Last thing I have for you. You look at the COVID recession here, which is very short, lasted like a quarter. This was the catalyst for the move higher here. COVID was the catalyst. COVID took people's faith out of a lot of things, but didn't take their faith out of real estate. It actually poured their faith into real estate. And that is one of the reasons why we have such a strong real estate market now, even with rates doubling this year. I mean, by the way, next week is Thanksgiving week. Happy Thanksgiving. And we've gone through this whole year with rates going up constantly the entire time. So much negative media, so many crash experts out there, so many professionals out there telling people, don't buy right now. This isn't it. All of that is what this market has been up against. It has done extremely well given the circumstances. All right, guys, here's what we're going to do. I'm going to play you a little tune. I'm going to let you know this. Thanksgiving week coming up next week. You know me. I make myself available. Availability, communication is key in this industry. If you need me this weekend, next week, give me a holler. Shoot me a text, a call, or an email. I got you covered. I'll hook you up. No lender fees. Get loan quotes easily. No need to pull credit. I'll tell you what's up. I'll take care of you. Have a great day. Have an awesome weekend. Take care, Tim.